Okay, it's a few minutes past the hour, so we will go ahead and get started. Again, if anyone has any questions, please do type those into the chat box and we will address those as they come up. But without further ado, let's go ahead and get started. My name is Alex Perny. I've been with Advanta IRA since 2012, so I have seen quite a few different shades of the market, although since 2012 we have seen a relatively stable increase in the value of most things that are on securities markets. So we will be covering some of the things that we are seeing currently in the markets today, and then also what people can do as far as alternative investments to try to hedge against some of those market volatilities that we are seeing right now. Just as a quick disclaimer, everything presented here today is for educational purposes only. Advanta and our employees do not provide investment advice, nor do we endorse or promote any investment products. All informational materials are for educational purposes only. All parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. So a few key points to take away. What's going on right now in the stock markets, as we've seen over the past few weeks, we've seen well over 1,000 points of shift just in the NASDAQ indexes, and then also the S&P 500 as well, going quite crazy if that's a good enough word to use for it. But there are a lot of things going on with a lot of external factors at play. We're going to go over some of the available alternatives to you as the investor on what you can potentially invest in to hedge against some of those volatile issues that you're seeing in the securities markets, and then what some of these potential issues look like for people investing for retirement. So when we're talking today, we're going to be talking about all of these different types of retirement plans and what you can do as far as investment options and what things might be affecting those. Here at Advanta, we do administer all of these different types of retirement plans, everything from traditional and Roth IRAs, but these kind of issues can crop up in investments with SEP IRAs, simple IRAs, solo 401ks, and qualified retirement plans, health savings accounts, education savings accounts, and even any type of other former employer plan. So things like defined benefit plans, deferred comp plans, governmental 457s, and thrift savings plans are all going to be affected by the tumultuous stock markets and the issues of rising inflation. So just keep in mind that even though here at Advanta IRA, we do primarily focus on IRAs, the issues that are going to be brought up in the alternative investments that we're going to review can be pursued within any type of these accounts, and those issues do affect all of these types of accounts as well. So some of the driving forces 2020 year to date are that we currently have one confirmed Fed rate hike with multiple predicted. Now it's kind of all over the place as to how many rate hikes we can expect on from the Federal Reserve, but currently right now we have had them confirm that in March they will be raising the internal lending rate for the Federal Reserve. So this trickle down will in turn cause money to get more expensive for people that are looking to borrow it, whether that's businesses and SBA loans, whether that is people looking to purchase homes and getting a Fannie or Freddie loan for that. Everything is going to get more expensive as far as money goes for people that are trying to borrow it. Now, that can have a few different impacts. That can cause real estate prices to dip because money gets more expensive and less people are buying property. So that can also bring up some opportunities, but it can typically have the effect of cooling off housing markets and with people that are looking to borrow money. Now, right now, we're experiencing at least records for this current decade and pretty much since the 90s of rising inflation and consumer pricing indexes. So the prices of goods that people have to buy, which is tracked by the consumer price index, is pretty much up about 7% on year to date, year over year. Now, some markets have seen significantly higher rates of inflation, things like used vehicles being up almost 30% for people looking to buy used vehicles, caused primarily by supply chain shortages with microchips and other industrial items that are needed to produce these types of of, of, of these types of goods. So you see people in secondary markets that are having high increases in costs. Now that can also help to draw down people, especially in retirement, if you need to buy something new. The rising inflation and the consumer pricing index being a very big thing to watch, as well as your retirement accounts, essentially meaning that if you do need to take distributions, that some of your monies can be worth less. Now, another big issue affecting the markets right now is the expiration of the CARES Act bond buying program. The phase out started last year of the federal government having a bond buying program to try to prop up bond markets, and those are all set to expire and phase out in this calendar year. So although a lot of the stimulus that we had seen in years past with regards to things like expanded child tax care credits and the actual direct stimulus payments, people have been kind of familiar with a lot of those things and the potential phase outs and the impacts that they have had. A little bit lesser known part of the stimulus program from the CARES Act and the other stimulus packages passed during COVID are set to expire. Mainly the one that has been kind of operating in the background is that the federal government had entered into a program to purchase issued bonds back to try to help keep the demand for them high, if albeit a slightly bit artificially done so. So with that ending and with the cost of money going to be getting more expensive with the Federal Reserve rate hike, definitely some things to keep in mind as people look to say, hey, we've been in such a strong market. How much longer can it continue? Well, some of the things that were helping to prop that up are set to expire or change. So if you're looking at a point at which some of these things might happen, it's a good degree of probability that we will see some shifts. How big some of those will be, it's impossible to say this year, but some of those external and internal stimuluses that have been affecting the markets are going to be changing in the immediate future. We also have seen a large price increase in fuel and transit costs. So the ability to move goods, not only are the goods harder and more expensive to produce with people paying higher prices for them, the actual movement of the products and things used to either make them or the goods themselves has increased dramatically, with fuel costs up and at least just call it transit costs up almost 20% with context of the consumer price index when looking at the numbers produced by the federal government. So again, take that for what it's worth as far as what that might mean, or if that's something that people deem to be more of a short-term issue. But we are seeing a large increase in the ability, or I should say the cost, just to move things around the world and the country in general. And we also have large amounts of pressing international political tensions that have to be factored into what our stock markets are going to look like in the near future. It is almost a certainty when there is external strife from the United States in any regard that's something that we are involved in or is involving our allies, that it's going to have some type of negative effect on our securities markets. Right now, the big pressing issue is the matters of Ukraine and Russia and NATO. With all those rising tensions in Eastern Europe, there are a lot of goods and things manufactured and other items that directly affect our stock markets, a lot of natural resources in that part of the world, and as well as the prospect of getting into any type of armed conflict being something that can certainly help to cool off investors with their driving forces, at least on the institutional level, to continually be buying large swaths of securities, which will drive demand and increase prices. Also, it has the effect of potentially cooling off the retail side of investors as well. Over the past year, we saw, at least for the past quarter, we saw about $30 billion of daily retail trading volume on the over-the-counter markets in the United States, which is absolutely astronomical. Typically, those are numbers that we had seen primarily just from institutional investors. So places like, let's say, Vanguard, which manage a lot of mutual funds that have large stakes in various companies that hold, millions of shares of things. Those people we typically look to see as being a large driving force of the total volume of the stock markets. But with retail investors being a large part of that, the prevailing sentiment of a retail investor, just someone sitting behind a computer and buying shares of stock, that can be much more directly affected by things on a day-to-day basis than the institutional side of things, which can have a very big detrimental impact on actual stock prices. So the potential for a individual investor to get spooked and then that have a cooling effect or a direct, call it a direct driving down force on potential prices in the market is also very great as well. So you have different aspects affecting all of the markets when it looks at the factors of stock prices. but you also have factors that typically haven't been seen in the past, like very high volumes of over-the-counter retail trading with people that can have that these things that are going on, such as inflation and international political tensions, can cause things to go one way or another very, very quickly. As we saw last Monday, we saw a huge dip in the Dow Jones Industrial Average. And even with the huge rebound yesterday, the NASDAQ saw the NASDAQ seeing a huge dip last week. The NASDAQ seeing a great rebound yesterday still had its worst year since 2018, had its worst month since 2018 in January of this year, even with the huge movements that were happening last week. So with that said, volatility is something that is going to be a very common occurrence, I believe, in this new year. And if anything is pointed true, at least over the past year, I think we can expect that, especially with some of the things that have been helping to prop up these markets going away. Now, with the Fed rate hike, money will become more expensive for retail home buyers, which, especially for people that are probably tuning into this, can create an opportunity for suppressed values or dropping values of real estate. If you're seeing it's really hard to find deals, then now's a potential time, with money getting more expensive, for a few different avenues for you to explore when it comes to investing in alternative assets. If the prices of houses drop, obviously that's going to create an opportunity for you as the investor to find potentially cheaper real estate. Now, that can also have the ability of less people maybe wanting to sell with the thought that their prices will go back up, but it is certainly going to affect maybe some short-term deals that can be seen. The longer trends are going to be much harder to pin down, but especially with interest rates going back up, it can give you the opportunity to potentially get into some more real estate deals. Now, also with real estate, or with money getting more expensive, it can also drive up the cost of the secondary mortgage lending market. If you want to lend someone money on a real estate deal, you might potentially be able to charge a higher interest rate, because the money that they're getting from you, or the money they're getting from more institutional sources, is getting more expensive. You can potentially raise your rates as well. So that's always a good opportunity to look for on the debt side of things. If your IRA, or you personally like to lend money out, with the institutional money getting more expensive, and it's been darn near free for the past several years, that is going to definitely create an opportunity for you there as well. Also, looking at the parity of the very high price stock market, we're seeing record highs of stock prices and stock valuations for companies. Some of the big people that keep getting picked on are people like Tesla or Apple, seeing what many people would consider to be overinflated valuations and overinflated stock prices. While that is certainly something to be aware of and watch, it also creates an opportunity for you that, if you feel now would be a good time, especially with some of the stuff going on, to take advantage of some of these market rebounds and use it to switch asset classes. Now, everyone always kind of thinks of, looking at hindsight in 2020. If you try to time the market right, you're probably always going to get it wrong. But with everyone typically having done pretty well over the past few years, minus the beginning of COVID, if you're looking to try to hedge against some of these issues that are going to be potentially coming up, now's a really good time to look at your performance of your stock portfolios, and maybe take into consideration changing over to an asset class that is not so price dependent on what you are looking to accomplish in retirement. Namely, if you need things like cash flow, dividends, and things like that, at least cash flow from securities, are typically always going to be pegged to the actual underlying security price. Now, things like real estate, your rental income, while certainly is going to be pegged in some way against the actual price of the real estate, more to the utilization of the real estate than anything else, not necessarily what you paid for it, the stability of rental income or mortgage payment income is going to be greatly illustrated when looking at what you could potentially see from dividend payments from securities, especially if you're someone in retirement, maybe living on a fixed income. Being able to have a much more accurate idea of what your fixed income is going to be and not have it fluctuate so much with the market is a very good option to have. So looking at switching asset classes is certainly something to do right now, especially since we've seen a good rebound from some of the tumultuous issues that we've seen in weeks past. Now, market rebounds have been pretty abrupt when there has been any type of issues over the past 2 years, again, with the exception of the first few months of COVID from about March to, let's say, September of 2020. All of the big issues that have happened have pretty much corrected themselves within a few days. Now, certain markets such as crypto getting absolutely hammered right now, and with it being a much newer asset class, kind of harder to peg down when something like that is going to rebound. But at least with securities markets, the rebounds are most likely going to be less frequent and less abrupt, meaning that if we do have a large sell-off or there is something that starts to depress the values of US securities, the timeline in which those things will rebound to either their pre-dip prices or if they even ever do get there is going to be certainly much less certain, especially with money getting more expensive and the stimulus portions of legislation setting to expire. Those types of rebounds can generally be seen to be much less abrupt and possibly take much longer to happen. Now, understanding that tangible asset prices take much longer to shift. So if you are looking to sell things like property, the prices of stocks and securities markets have a much less direct correlation to prices of things like real estate. Now, they are going to certainly affect it, and depending on how you're invested with it, can either have no effect on it or it can have a much slighter effect than if you actually needed the price of some type of cash alternative, something like a mutual fund or a stock that can be openly traded on a market exchange. Again, can be greatly illustrated when buying things like tangible real estate. So some of the benefits of alternative assets, and we're going to get into specifically what I mean by alternative assets, but if you think about it in a very broad context, anything that's not on a tradable security market, so stocks, bonds, mutual funds, foreign currency, all of the things when I refer to alternative assets are going to fall into buckets that aren't associated with those. Tangible assets such as real estate can produce cash flow relatively independent of price. Now, I mentioned before, granted, if you buy a $100,000 property, it's probably not going to rent out for the same amount as a $500,000 property, but if the property were to fall in value by 20%, rents don't correlate. There's not a corollary directed at the rental income. If you have a year-long lease signed and the property value goes from 100,000 to 80,000, you don't see a 20% dip in your rental income. So long as that renter is still there utilizing the property, you still get the same amount of money deposited into your retirement account each month, or be able to draw that cash flow out for expenses that you would like to use for living in retirement every month. Now, if you were dependent on stock dividends, which maybe are a percentage of the value over a running course of a few months, that could be a huge impact. You could see a potential 20% dip if you're relying on stock dividend income for your retirement. You could see a huge dip in the amount of money that you have on that fixed income. So tangible assets, especially things like real estate, can offer a very good degree of insulation from stock market dips. Now, granted, you also have to take into account that nothing is without risk. If someone loses their shirt and they are renting your property and they can no longer pay rent, then that obviously certainly is an issue that you would need to overcome. But in most cases, people typically like to stay with a roof over their head. So the utilization aspect of a piece of real estate and the ability to retain that cash flow, you not only have what the decisions you've made in purchasing that type of asset, but also the desire of the person that is paying you to stay within the confines of obviously the house that they're renting from you. And you also have, when you're doing alternative asset investing, the ability to, renegotiate something. So if you don't necessarily just want to lose a tenant and then have to go out and find someone new to use the property, especially if everyone's getting hammered in the stock markets or people are losing their jobs, you have the ability to go back and renegotiate and keep that cash flow in place. You might be able to reduce the monthly payment. You could also defer payments in some cases. You have the ability to make all of the decisions when it comes to how the assets are utilized and how you actually put out the assets in your account into a particular market. So with those options comes a great degree of flexibility in how you navigate some of these very big issues that are being seen in the stock market. And you also have a lot more ways to create cash flow from a single asset. So let's say the rental market is starting to get depressed in the area that you own real estate. Well, if the rental market is seeing issues, but you maybe want to sell property, you could potentially sell that property. But let's say that you would still want to keep the monthly cash flow and maybe wanted to hold the note on the property. You could do owner financing on the property so that way you still maintained a secured interest in the property, sell the property out of your retirement plan's name so you no longer have to deal with maintenance and taxes and things, and create a steady cash flow at a certain fixed rate of return for your IRA or any other type of retirement plan. So unlike with securities where it's just either the value of what you sell it for and make a return that way or dividends, you have a lot of different ways to choose on how you market and utilize tangible assets such as real estate within retirement plans. You can also do things like creative leasing. So you could do a master lease with the property you own. Again, you could sell it and hold owner financing. You can use it as collateral to borrow more money and buy other types of assets. So with things like alternative assets, you do have a greater degree of flexibility with how you create cash flow. Again, very important to understand that. You also have other alternative assets such as precious metals, which have historically been used to hedge against inflation, which currently is at record highs presently. So in most cases, the value of precious metals such as gold, silver, platinum, and palladium rise when there is high inflation. It's just a historical factor. I am by no means an expert on why exactly that occurs, but they're typically seen as a hedge against inflation. Now, Warren Buffett is quoted as saying, they look great and they can protect against inflation, but they don't pay a dividend. So an asset like precious metals is not going to be a cash flowing asset, but if you wanted to have a portion of your retirement plan that was vested in a tangible asset that would hold value relative to the buying power of, let's say, the US dollar, precious metals would be a very good thing for you to look into purchasing with an IRA, which you are certainly allowed to do. We have clients that hold precious metals such as gold American Eagles uh, or American Buffaloes. They also hold other foreign government issued precious metal coins. So if you'd like to buy something like that, you're certainly able to do that within an IRA as well. You don't have to take a taxable distribution and pay taxes on that in order just to buy precious metals. You can buy those things directly within an IRA. One of the biggest things that people often overlook when it comes to just rising inflation, past just what it means for the dollars in their personal bank account, is that especially if you're someone that is looking to retire in the short term, or if you are going to need to start taking payments out of a retirement plan, so it's just an IRA or 401k, is that the money being taken out, if there's rising inflation, is going to be worth less. Not worthless, but just worth less as far as what you can actually purchase for the same amount of money versus a given time in history. So if you have rising inflation, the need to have something that is either a very steady cash flow or able to have appreciable gain in assets is very important, because people often just look at, hey, what can I do right now? But if you're looking at investing and you're looking at rising inflation, if you're seeing 7% inflation, which again is hard to say if that's going to be something that is systemic or if it's going to level out at all over the next few years, that you need to make at least 8% just to beat inflation. So if you're doing that with your stock portfolio, great, but it can take one day to wipe out those years of gains. So investing in things that have a much more stable price or can cash flow a lot better will help to hedge you against the issues of inflation going on in the future. And then also understanding the different types of assets that can be held in a retirement plan is key to, again, helping you to fight against inflation when it comes to the purchasing power of what you have within a retirement plan. So some of the different types of options as far as alternative assets goes to help to protect you against some of the big market issues that we potentially see coming up in the next year. You can buy almost any kind of real estate asset that you would like to with an IRA. Real estate being obviously the most popular thing that, or I shouldn't say obviously, is being one of the more popular asset classes that our clients invest into, but it's not kind of one size fits all. If you are familiar with one type of real estate, you can certainly pursue that one single type and just, have at it with your IRA. But if you want to maybe get into other things, or you're just concerned that there might only be one option for you, we have clients that invest in rental homes, commercial real estate. If you want to do a fix and flip, you can buy condos, duplexes, multifamily property. You can invest in syndications, private REITs, and land. So depending on what maybe is a available real estate asset in your particular area, or should say class of real estate within your area, if you know and understand that, you can certainly use your IRA to buy that. It's not going to be something where we at Advanta are going to tell you you have to invest one way or the other. If you find a deal and you think you can make it work, we can structure that within your IRA plan. Now, let's say that you're less apt to dealing with tenants and toilets, and you want to maybe use your IRA to lend someone money to hold the secured interest in the property. So you act as the bank. Again, with money getting more expensive from the institutional side of things, I think it's really going to open up a lot of opportunity for people to be private lender or utilize their IRA and retirement accounts to get involved in private lending. Now, you don't necessarily always have to hold a traditional note and mortgage with the IRA. You can invest in many different types of paper assets, if you will. You can do a mortgage loan. You can also buy tax liens and tax deeds from municipalities, which might be getting more prevalent if there's going to be any issues with the economy. People being less likely to pay expenses that they have, such as property taxes, might also be a good time to look into tax lien markets, because those certainly might be have more options for investors here in the near coming future. You can lend someone unsecured debt. So if you just want to do a personal loan to someone, granted, that's going to be a significantly riskier proposition potentially if there is no security against the actual loan, and you would have to potentially sue someone to recover your money. It is certainly something you can do. There's also debenture notes, option contracts. You can invest in assignments of purchases of real estate. So getting a piece of real estate under contract and flipping the contract. You can even buy things like accounts receivable with your IRA if you're interested in paper assets. And then there's certainly many different other alternatives. So you can invest in LLCs. We've had people secure notes with farm animals. There's different types of limited partnerships, people investing in movies, precious metals, equipment leasing, foreign exchange. Granted, foreign exchange in the context of volatile markets is probably one of the most volatile things you could potentially get invested into, but it certainly is an option. Private stocks, if you wanted to invest in a startup company or someone that maybe is positioning for something that is going to be very beneficial, you can certainly invest before they get out onto a stock market. And also investing in things like commodities and oil and gas is an option for you as well. So the first case study that we're going to look at is buying real estate in a traditional sense of just buying a rental property. So in this case, John wants to use some of his 401k from a previous employer to purchase a rental property down the street from his house. So what does he do with this? He's decided that his old 401k is getting hammered by the stock market, and he wants to buy some rental property with the IRA. So from his perspective, it's very straightforward. He needs to open and fund the IRA account. He has found the investment property, he's done his due diligence and found something that he feels is going to work well in this particular instance. He submits the purchase authorization forms, then he also reads and approves any and all documents for the IRA that we have to sign. So then we work with the closing agent to ensure proper titling on all documents. We sign all documents on behalf of the IRA. We wire the funds to closing, and we hold the deeds and copy of all documents for the real estate purchase. So it's a very simple process. There's no complicated tax forms that John needs to be aware of. Everything that is normally involved in a purchase of a piece of property still holds true in this context. So what does the actual investment strategy look like? So if the property is rented for 2 years, $1,200 a month, that's $28,000 that John has coming back tax-free to his IRA in those 2 years. That is fantastic cash flow coming back into the IRA just after 2 years, especially on the property purchase of $120,000. So let's say, again, maybe not the greatest time to sell, or maybe it is a good time to sell depending on what your market is. But John's case, in 2 years, he decides to sell the property for $170,000 and $50,000 of that being profit. So there's no taxes paid on the $28,000 in profit that he realized from the 2 years of it being rented out and the $50,000 in profit that he made just on the sale. Bought it for 120, sold it for 170. So John now has $198,000 to invest with his IRA. Now, I think you'd be kind of hard pressed to show me one single asset that could reliably do that within a security market, or at least with the amount of security that real estate would have. Because again, even if the property went down in value, let's say he only sold it for 130,000, only made $10,000 in profit on the sale, he still would have made the exact same amount if it was rented out for $1,200 a month over 2 years. So again, that rate of return not being pegged to the underlying price of the asset is a very big benefit in a case like this. Now, sometimes people may not necessarily want to directly deal with tenants and toilets. So investing into some type of syndication or limited partnership that's maybe purchasing things like assisted living facilities, or that is purchasing apartment buildings, might be more attractive to an investor that's looking to get into alternatives to the stock market. So with this type of investing, the IRA is not actually purchasing the property directly. They're investing into a limited partnership. So here's Jane and Rocky's deal. Jane has over 100 grand in her IRA with Vanguard and meets Rocky, who has a private offering to purchase and remodel an apartment complex. Jane's okay with the terms of the deal. Rocky provides Jane with a prospectus and all of the subscription documents, and projects that the project will be 70% leverage, so there's going to be some debt involved. But again, this is all disclosed typically in the front end of investing in these types of assets, so you can make an informed decision. So Jane decides that this is a good fit for her and decides to move forward. So just as in the previous instance with John buying the rental property, Jane opens her IRA account. She moves the funds over from Vanguard, the 100,000 over from Vanguard, and submits that transfer request with us and waits for the funds to arrive. So the investment process, again, with this is also very simple. Jane's account manager works with her and her investment provider to complete all of the investment documents in the name of the IRA. So in this case, the subscriber's name, instead of being her name personally, would be Advanta for the benefit of her name, IRA number. Everything is reported to the tax ID number of the IRA, not you personally. So in either case of buying property directly or investing into a syndication, none of the income is going to be reported back to you personally. It's all reported back to the IRA. So you don't have to worry about any complicated tax reporting. At Advanta, we take care of all the tax reporting on the IRA side of things. And going forward, there's quarterly distributions of $2,000 a quarter. So $8,000 a year on her $100,000 investment is sent directly back to Jane's IRA. It goes back in there tax-free, not included on her personal income statement. So again, a great way to get involved in real estate if you don't necessarily want to be involved with the actual management of the property per se, and you want a much more passive take on investing in tangible assets. Looking at investments into syndications or private placements can be a great alternative for you as well, while investing in something that is tied directly to real estate, and maybe not necessarily something that is just as common as looking at things like real estate investment trust, which typically are going to have a much lower rate of return and are, again, highly illiquid. So looking at the private syndications and private placements, another good alternative if you're looking to get out of the stock market directly and into alternative assets that aren't tied directly to the stock market. So with that said, that's pretty much all we got for you today. I wanted to keep this one a little bit short just to make sure people were aware of some stuff that's going on and understanding your options out there. I'll stick around for a few minutes if there are any questions. If not, I hope everyone has a great rest of your day. And if you have anything that you'd like to talk with me directly about, my contact information is right up there on the screen for you. All right, well, I see everyone logging off, so I'll go ahead and end it there. Thanks for joining with us today and hope everyone has a great day.